it going, guys? I wanted to get back on here. It's already the end of November. Absolutely crazy. 2022 is almost gone. I mean, just like that. Seems like it just started. I mean, the year is going absolutely flying by. Pretty soon it's going to be Christmas time. Then we're on to the new year, new me stuff. All of the New Year's resolutions that normally last until January 15th, and poof, they're gone, right? That's another conversation, and it's one of my favorite podcasts and topics to talk about come during the new year is the new year, new me trends. But hope everybody had a really nice Thanksgiving. I got to go up to Lake Tahoe for a little bit, spend a little bit of time with family, see the snow, which was awesome. We're starting to get the winter storms coming up here through Northern California. Going into Christmas time, going to actually be heading out to Las Vegas here for a quick trip to go rope in the World Series finale coming up. So hopefully I have some good stories for you guys. Hopefully go down there, rope well, and have the opportunity to win a really big check. So trying to practice up and get ready to head down to Vegas for that quick trip. And again, before we know it, I'm going to be contacting all of you that are clients about our semi-annual reviews. We'll be getting together come January and February, going back over the performance of your accounts, your financial plan, all that good stuff. But jumping into the markets here, what's been going on in November? What do we see going forward? What are we doing with our models? Where's everything at? So year to date, let's look over what all the indexes are doing. So I included Pulse into this conversation. It's a position that we're currently holding. It's a short duration bond position. And I'm going to talk a little bit more about it, but I just kind of wanted to show you guys how that's been performing. So year to date, this Pulse short-term, 30-day bond ETF is up 1%, which is fantastic. Normally, kind of a funny year. Hard to tell you, hey, we're going to hold a position that's only going to be up 1% during the year. Most years, people would be very upset about that. Now, 1% seems absolutely fantastic. So it's been performing very well. The Dow has been making a big rally, down only about 6% now year to date. The S&P is down about 15.5%. Emerging markets, I wanted to include this into here because there's an interesting story as well. But the emerging market sector down a little over 18%. NASDAQ, again, tech-heavy index has been getting beat up all year long with these raises on interest rates. No new news here for you. Down 27%. And always got to throw in Bitcoin, down 63% year to date. I know Bitcoin is not the be-all, tell-all of the crypto world, but it is one of the major players, obviously. So like to include that there. So year to date, it's still not unrealistic for your portfolio to be down somewhere around the 15 to 20% range, depending on how aggressive that you are being. If you're down over 25, 30%, higher than the NASDAQ, you probably are overexposed in certain sectors. You probably want to take a look at potentially rebalancing your portfolio, making sure that you're taking on the right amount of risk, being that the overall market is down more on that 15 to 18% mark. So year to date, again, doesn't look awesome. Probably going to be closing out the year down. That doesn't happen super often, especially with double-digit numbers, but historically, when we're down like this, normally the following year does pretty well. So we'll see. But one thing that I want to show you is over the last quarter, what things have been doing. It looks like a whole different picture, right? It's absolutely crazy. So the Dow is actually up almost 20% quarter to date. Emerging markets are up 13.5%. The S&P is up 12.5%. The NASDAQ is lagging, so it's overperforming on the downside and underperforming on the upside. Only up about 8% there. Pulse, again, our 30-day duration bond fund is pretty dang constant there, up 75 basis points. Bitcoin down about 12%. So basically, the moral of the story here is looking at the emerging market space. A lot of people kind of will talk about emerging market, and this is talking about foreign overseas markets. Basically they're an underperforming sector. Why would you ever hold that? They don't normally perform as well over the long run as the overall market does, especially large cap domestic stocks. Well, the reason being is it's just another level of diversification. Like I'm talking about, all of these different sectors, if we can spread our money and diversify and be long-term invested, we don't have to have these gut reactions to wanting to sell and sit in cash and miss these upturns. Because realistically, if you sold 4 months ago and you missed this quarter to date swing right here, that really, really hurt your portfolio. That's how you can be down 30, 40%. Say you were overly exposed to tech companies and you were being, investing very aggressively, kind of like you were going to rebound back in 2020 and all these high flying tech stocks. and then you got scared and sold out, and you miss a potential, 15 to 20% upswing in 3 months just like that. I mean, we can't be in a position to miss these updates. So we have to be invested into a manner where you feel comfortable, where you're confident in what you're invested in, and we can stick it out from the long term. Because again, volatility is not always to the downside. Volatility can also mean very, very quick rebounds. And if you miss them, that's how you can really, really get hurt. So a couple things I want to talk about. I said I was going to talk about Pulse here. It's kind of an interesting story. So normally with our investments, and again, if you're a client, you already know this, but we invest in a core and satellite model. So basically, the majority of the money is invested in the core part of the model, long-term diversified across ETFs and mutual funds that we only rebalance 1 to 3 times a year, depending on market fluctuations. But then our satellite positions, we do invest, somewhere between 5 to 20% of a client's portfolio into individual stocks. Again, more short-term plays based on what's happening in the market. Right now, we've been holding on. Instead of investing into individual stocks, we put all that money into the short duration bond fund Pulse. The reason being is we still see a lot of market volatility coming forward. And actually, the Fed just came out. We're going to talk about that in a second. The markets are currently rallying hard. It's about 11:20 in the morning as I'm recording this, and they've just skyrocketed up. Based on what's going forward, we've had China protests right now, the Fed meeting coming up December 14th. There's still a couple of headwinds that we got to get through. I think that there's going to be some more volatility. So rather than just sitting in cash, earlier in the year, we were 15 to 18% cash. We've put all that money into the short duration bond fund just because we can get a risk-free return of roughly 4%. And that's probably going to increase after December as well as the Federal Reserve increases interest rates. So we might as well just sit there, capture that 4% a year for the time being. A lot better than just sitting in cash and getting nothing. We will be returning that position back into some different stock plays. On the investment committee, we have been talking about that on a weekly basis, which stocks we're going to actually be getting into, but probably come the beginning of January after the Fed meeting and after we have a better idea of what may come in 2023, we will redeploy that position out of Pulse here and back into some individual short-term stock plays. But again, it's been a fantastic story looking at this over, especially year to date, being that portion of money has been up, even though it's 1%, it's been up for that entirety of the craziness of this year. So the good thing about interest rates increasing is you can get a pretty decent risk-free rate of return, meaning that we have to have a very, very strong conviction on which stocks we're going to be picking in order to take money away from that 4% risk-free rate of return and put it into something a little bit more risky. So I want to look at what happened to the markets today. An interesting thing that Jerome Powell came out and just said. So again, markets absolutely just rebounded really, really quickly today. When I woke up this morning, everything was down a little bit, about 50 basis points, nothing crazy. But for Jerome Powell came out and said this, and now market's up about 1.5% across all the different indexes. So he says, it makes sense to moderate the pace of our rate increases as we approach the level of restraint that will be sufficient to bring inflation down. That's what we've been waiting for. We've been talking about this all year that, hey, once the Fed comes out and says, hey, we can take our foot off the metaphorical brake, we're going to see a rebound, and it can happen really, really quick. And he's saying it. Again, he's not saying we're done increasing interest rates, not saying that inflation is tampered. He's not saying that we're going to, go ahead and put it all on black again. But he can slow down on increasing interest rates and slow down on bringing pain to the economy. That's a much different conversation than the Federal Reserve was having, 3 or 4 months ago when they were saying, hey, we are willing to short-term hurt the middle class in order to make sure that we don't have a long-term recession. That rhetoric is really starting to change. And we've been in a place where bad news is good news. If we have bad unemployment numbers and we have, some bad economic data coming through, it's good news because that means that inflation can be slowing. It means that the Federal Reserve can slow down on their raising of interest rates and slow down on their monetary policy that they've been conducting and let the economy have a little bit more room to breathe. And that's what we're seeing here with Jerome Powell saying this. And again, who knows? We'll see what happens come December 14th with their next rate hike. Now they're saying they're only going to raise 50 basis points rather than 75. But I believe that we'll probably see another short-term rally here just as investors get excited for the future based off of that position that Jerome Powell has been saying here. So that's what happened to the markets today. They're doing really, really well. Looking at the 1 day here, yeah, every single index is absolutely shooting up. It's been a fantastic day. So last thing that I want to show you guys here, I'm going to switch my screen real quick. Stop sharing here. I drew this myself, guys. So I'm quite the artist. Don't be too impressed by how good of a drawer I am, but it gets the point across, even if it does look like a kindergartner made it. So looking at, risk over time, and it's been really, really interesting this year because everybody has become risk averse with the downturn in the market. It's, again, we've talked about it a lot. You get that gut reaction, you see your account down, you get nervous, and you want to sit in cash. Well, looking at actually how risky is cash versus bonds versus stocks. Cash actually over time is the riskiest investment that you can have. Yes, over the short run, sitting in cash, it's not very risky. You don't have much potential to lose. If you're holding cash for 3 or 4 months, you're not really hardly losing to inflation. But if we look over a long time frame here, the longer and longer that you actually are holding onto cash in your accounts, you are losing with the opportunity cost of how well bonds and stocks, and even losing just to inflation. So I always am very, very much, yes, you need to hold cash and have an emergency reserve, and there's obviously a place for that. But within your investment accounts, we have to very much try to avoid jumping in and out of cash positions or holding on to cash because we're nervous about what's happening in the economy, because we can miss these returns just like we've been seeing over the last couple months. And that's what can really, really hurt your portfolio. So holding on to cash, yeah, it might seem like it's a riskless investment, but actually when you look at the opportunity cost of what your portfolio should be doing, it's very, very risky the longer and longer that you hold onto it. So then when we look at bonds, again, people say, oh, I'm risk averse, Hunter, I should be 100% invested in bonds. Well, being 100% invested in bonds is actually more risky than being 80% invested in bonds and 20% invested within the equity market. We have to have that sort of a counterbalance. And over time, actually, the longer that you hold on to bonds, the longer the duration that you have on them, the more they're going to be affected by changes in interest rates. So if you're holding on to bonds, for 10, 15-year bond and there's a change in interest rate, that price reaction is going to be more volatile than if you're holding a midterm, 30-day, 1-year bond. That price change is not going to be as dramatic. Again, as bond price or as interest rates increase, bond prices decrease. They work inversely of each other. So actually, it's funny, yes, holding on to stocks, or just not even individual stocks, just the equity market as a whole. We're even talking about just the S&P 500, right? It is very, very risky to hold on to when you don't have a lot of time. Who knows? I mean, we've seen it this year where the market can drop or go up, 2, 3, 4% in a single day. I mean, it's terrifying when you wake up and the market's down 4%. I get that. But over time, the investing in the stock market has always rewarded long-term investors. So I show you this. I know that we talk about this all the time, and there's just so many different ways to look at it and explain it. But when we look at a long time frame and we look at what your potential goals are, you have to keep in mind that holding on to cash is actually a much riskier investment than staying invested within the bond and equity markets. So that's why it's just so important to have an understanding of why you're investing, what you're trying to accomplish, what your time frame actually looks like, because then we can have an understanding of the amount of risk that we're taking on. Yes, if you're trying to accomplish something within 2 years, then we don't want to be invested within the equity market and be taking on a lot of risk. But if we're talking about your retirement scenario, investing for something that you want to accomplish, 5, 10 years down the road, then sitting in cash is actually way riskier than being invested within the normal bond and equity market position. So with that, guys, again, I hope that the end of the year has been treating you well. We'll jump back on here at the end of December, right before 2023, before the new year, new me video. One of my favorite ones, again, to record every single year. But I hope that everything's going well there. If there's anything that I can do to help, please feel free to reach out anytime. Would love to chat and would love to talk about you and your financial goals, how you can reach them while taking on less risk. So we'll talk to you guys next month, and have a great rest of your day. Take care, everybody. Bye.